Here at the Yukon Project, we've heard people complain that they have a good credit score, and yet they're still being denied for a personal loan. What gives? If you're looking for a substantial personal loan, say $20,000 or more, it's natural for you to ask the question of what credit score you need in order to be approved. And indeed, most people believe that their credit score is the most important factor in determining whether you're approved for a personal loan. It's actually a bit more complicated than that, but that doesn't mean that it's confusing. Your credit score does indeed play a role in the kind of personal loan you can get, but it often isn't the deciding factor. And some lenders won't even look at your credit score. Many lenders look specifically at the data in your credit report and create their own score for whether to approve you. These lenders don't publish their decision criteria. They see it as part of their business secret sauce. But your FICO score is essentially a 3-digit number that distills down all the information in that credit file. So it's natural to think that credit score is the most important factor in whether you're going to be approved for a loan. And your credit score will play a role in the kind of loan you can get. The higher your credit score, the lower the interest rate that you will end up paying for your loan. Credit scores are trying to predict the likelihood that you will default on a loan in the next 18 months. For every 40-point drop in your score, the percentage of people who will default on a loan doubles. Of course, that is just a rough estimate, but it gives you an idea of why lenders care so much about your credit score. So less than 1% of people with a credit score above 740 will default on a loan, but more than 10% of people with a credit score below 600 will default. The lender has to price the interest rate to compensate for the default losses. Because the default rate goes up exponentially, the interest rate also goes up quickly. Of course, if the lender could predict precisely which people will default, they just wouldn't approve them. And that's what their lending algorithms are trying to predict. But because they can't pinpoint the defaulters directly, they have to price loans to compensate for the percentage of people who will fail to repay their loans. So your credit score will play a big role in the interest rate that you pay for the loan you get. But it doesn't necessarily play a direct role in whether or not you are approved. There is an exception to this rule, and I will mention that a little bit later. Whether you are approved or not will depend heavily on several other factors of your financial situation. As you can imagine, your income plays a big role. If you have limited income, a lender will not offer you a big loan because you're unlikely to be able to pay it back. Related to income is your debt-to-income ratio. If you have substantial income, but you also already have substantial debt, your debt-to-income ratio would be high. That is likely to scare off lenders because they would be concerned that your monthly budget could not absorb another debt payment. To calculate your debt-to-income ratio, take your total monthly debt payments and divide that number by your total gross monthly income. Then multiply by 100 to get the percentage. If your debt-to-income ratio is about 40%, you might struggle to get approved regardless of what your income or your credit score is. So in general, your credit score will determine your interest rate, but not whether you're approved. But there is an exception to that rule. Lenders often balk at giving large loans with high interest rates. This is because the loan itself can be so burdensome as to cause the default. It becomes a self-fulfilling prophecy. So even if you have good income and a low debt-to-income ratio, if your credit score is low, they might deny you because they don't want to offer you a large loan with a high interest rate. Of course, we can't tell you exactly how a lender might react to your unique financial situation. Even if we did know your particular details, lenders do not publish their approval criteria. So every lender will have a different algorithm for deciding who to approve, how much to offer, and at what interest rate. For that reason, the only way to get the best deal you can in your situation is to shop around. If you can, you should get 2 or 3 approved offers in hand before you accept a loan. At the Yukon Project, we've tried to make shopping around easy. If you visit our lending marketplace page, you can put in the purpose of your loan, how much you need, and your credit score range. When you apply to one of our featured lenders, we'll automatically check your rate with up to 40 other lenders behind the scenes. Our partners use a soft credit check, so applying won't hurt your credit. We will show you all of your approved offers so you can pick the loan that's best for you. If you found this information helpful, please like this video and subscribe to our channel. Doing that helps the YouTube algorithm find other viewers for this video. It helps us out, and we appreciate your support. Thanks for watching.